Okay, so this is probably one that you've all been waiting for. So let's not waste any more time and begin. All right, so chapter 1, understanding the new day opening gap. I'm going to start off with just the new day opening gap first, and then we'll move on to the new week opening gap. Okay, so you might see a few little things get repeated throughout the presentations, but that's only because I want them to be ingrained inside your mind. Okay, so new day opening gap, NDOG, defined by the inner circle trader ICT as the separation in time/price caused by the 1 hour break that occurs each day in the futures market. Now, yes, this is specifically meant for trading futures, but I have seen people use it on Forex, stocks, and so on and so forth. Now, opening price of the gap, the very first tick that occurs at the 6 p.m. UTC -4, I believe that's the right time. Restart. Closing price, the 5 p.m. close of the previous trading session. So usually the previous trading session closes around 5 p.m. and usually 6 p.m. is when the session opens up again for trading futures. This gap forms every day from Monday to Friday, excluding the gap between Friday's close and Sunday's open, which is referred to as new week opening gap. But like I said, we'll talk about that in a bit. This gap creates a liquidity void on the price chart, indicating areas where no trading has occurred. How to identify NDOG? You start by noting the close price at 5 p.m. of the previous day. Identify the opening price at the 6 p.m. time. Highlighting NDOG, highlight the range between the previous day's close and the current day's open on a lower time frame. So it can be like a 15-minute time frame as well, but I would much rather you look it up from like a 5-minute and mark it up from there, but you can mark it up however you want. This is just to visualize the gap effectively. Now, consequent enroachment, calculate the midpoint of the NDOG using Fibonacci retracement, anchoring from the previous day's close price to the current day openings price. This midpoint acts as a significant level for potential price reactions. I'm going to zoom in real quick just so you guys can see this example a little bit better. But as you can see, price had closed here, right, at the 5 p.m. and then at the 6 p.m. it closed here. And from what you can see, this is the midpoint of the NDOG, right? Pretty nice, pretty simple. And there's even indicators for this, which I will share in the description below, so that way you don't have to worry about marking them up yourselves. Now, what is the importance of NDOG? Dynamic fair value level. New day opening gap serves as a real dynamic fair value level, representing a range between the previous day's close and the current day open. And as you can see, price seems to react pretty favorably when it comes to this. All right, so another thing is market sentiment. It indicates market sentiment and potential price direction. A gap up may suggest bullish sentiment, while a gap down may indicate a bearish sentiment. Now, I'm not gonna lie, sometimes it seems the opposite. Sometimes bearish fair value gap might actually make price go bullish, and a bullish fair value gap sometimes make price go bearish. I don't know why it happens like that sometimes, but if I was you, just look at ICT's examples when it comes to this, but that's just my opinion. Now, support and resistance. The gap up acts as a support zone, while the down gap serves as a resistance zone. Now, I want to show you two sort of distinct examples here real quick. Okay, so here you can see the new day opening gap here. Here is one where price is just reacting normally off of it, right? As you can see, price is bullish, price taps into it like twice, and then goes back up to being bullish again, right? But here's the interesting part. Here is where AMD comes into play: accumulation, manipulation, distribution. So as you can see, price is manipulating above the new day opening gap. It accumulates first, manipulates second, and then distributes down. You'll see that probably more often than not. Why? Is because price knows that a lot of people will be setting their stop losses above this gap. So what it'll do is it'll accumulate, making you think that it's going to start going down or going up, and then it'll manipulate you into thinking it's going up while in reality it's trying to go down, right? So just keep an eye out for these things. It's very, very crucial, especially when trading these. Now, what I will say is it's not important to trade with new day opening gaps or new week opening gaps. It's not. People have been making money long before this idea, and people will continue making money for it. So don't get too hung up on this, okay? Okay, so trading strategies involving new day opening gap. One strategy is revisiting gaps. So price often revisits new day opening gaps. The new day opening gap acts as a magnet, drawing price action back towards it within its 5-day cycle. It's got a 5-day life cycle, okay? So it's Monday, Tuesday, Wednesday, Thursday, and then Friday, right? When the price moves away from the new day opening gap, it may return to fill the gap, providing potential trading opportunities. Next is market dynamics. Understanding the new day opening gaps helps anticipate market movements. A significant gap may indicate strong buying or selling pressure. So again, it depends on how big and how small it is, okay? Support and resistance levels use the new day opening gap as a potential support or resistance when setting entry and exit points. So as you can see in this example, what do we have here? Price is coming down towards the new day opening gap, but as you can see, the structure was already bullish. We have a sweep of liquidity. This fair value gap gets inverted. You enter off of the candle that closes above it, and then you just target the external range liquidity that is resting out here, right? You can use unicorn models as well, whatever you want. I believe this is actually kind of like a unicorn model, sort of, but you can use whatever you want when trading these. Just make sure you're back testing this, and please don't just trade this blindly because you think it's cool or because ICT says it. You need to master this first before trading with it. Me personally, I don't really use this. I don't find it that useful, but again, you can do whatever you want. Now, it's a practical application of NDOG. This is something ICT recommends. Recording new day opening gaps. Maintain a log of new day opening gap highs, lows, and midpoints. Use these levels as potential support / resistance areas for the next 5 days, okay? Now, if you're a support and resistance trader, this is probably the best way to go about it. Gap filling. Be aware that not all gaps are filled completely, and unfilled gaps can create a fair value gap for later trading opportunities. Or simply, the gap will never get touched. That can also happen, okay? But you have to be aware that sometimes they won't always get filled all the way, or they will get touched into at some point later on down the line. Next is the life cycle. New day opening gaps have a life cycle of 5 trading days, during which they act as magnets for price action. Okay, so remember, keep that in mind. Open up a chart and try to see if you can spot something like this, okay? All right, so chapter 2, the new week opening gap, NWOG for short. Let's begin. Okay, so let's start with the definition of new week opening gap. This refers to the gap that forms between the Friday close and the Sunday / Monday open when the market resumes trading after the weekend. Opening price, the first tick at the Sunday / Monday open. Closing price, the Friday close. This creates a dynamic fair value level between these two price points. Does not include the daily 1-hour break. That's the new day opening gap. Key characteristics. Range definition. New week opening gap is defined by the Friday close and Sunday open prices. Liquidity void represents a liquidity void similar to new day's opening gaps where no trading has occurred. Life cycle. New week opening gaps have a 5-week life cycle and can act as strong attractors of price action during that time. So let's just look at this example real fast. I was just using an indicator for this, okay? It's just easier that way. And here you can see price first had pulled into that gap, right? It retraced on Monday a little bit and finally bounced away from it. And then once price finished the market maker buy model and touched up on a array or PD array on the higher time frame, the market maker sell model starts and it starts coming into that new week opening gap once more. Pretty cool, right? That's pretty neat, huh? But it won't always look like this, okay? You guys know I cherry pick my examples. It's only to illustrate what I'm trying to teach you guys in an easier manner, okay? Okay, so let's talk about its usage in trading. Before I forget, I actually borrowed the Lux Algo trading chart because I was using their indicator for this. So shout out to them, and I'll link their channel and indicator in the description down below. So recording new week opening gaps. Keep track of at least the 5 most recent NWOGs. Monitor these gaps as they are impactful on market movement. Next is Event Horizon PD Array, EHPDA. Event Horizon, an intermediary level constructed from the average between neighboring new week opening gaps or new day opening gaps, calculated by finding the 50% distance between two NWOGs or new day opening gaps as well. Price tends to react to this level. So this is kind of new, but yes, guys, you can find the midpoint between like a new week opening gap and then the other one. You just use your fib and you'll find the 50% that way. It's a lot easier. Market impact, EHPDA levels will not allow price to escape to the new week opening gap, creating a surge towards the new week opening gap that price got too close to but has not yet reached. Can act as a premium/discount zones between new week opening gaps, and it applies to NDOGs as well. Market structure analysis, extend the new week opening gaps forward in time to observe how price tests and respects these levels. Price may consolidate around or sharply move away from these gaps. Very important. Price may consolidate, okay, and it also can move away really quickly. Directional bias, clustering of new week opening gaps above or below the current market price can provide a strong directional bias. Helps anticipate potential breakout or breakdown moves. Now, I want to zoom into this example a little bit for you. Now, I believe these are all new week opening gaps, if I'm not mistaken, but if you were to draw your fib from here to here, that gives you the EHPDA or the 50%, right? And something very interesting here. So once you guys notice that this 50%, right, you'll see price typically touch onto it, and the only time it will break through it to touch another new week opening gap is when the market maker buy models or sell models start interchanging, right? Or if you're going from IRL to ERL. And what I mean is, let's say price here touches a PD array in the higher time frame, and now what does price do? It comes down to the new week opening gap here and then reacts off of it and then goes near the EHPDA, and as you can see, it doesn't break through it. As a matter of fact, it breaks through that new week opening gap, right? Breaks through it, and then this turns from a support to a resistance. Price comes down, right? Because we're in the market maker sell model now. It goes down, taps into the gap here, in this gap, reacts off of it, touches the EHPDA perfectly in the center, right? Reacts off of it, doesn't let price break through it because again, it's respecting the market maker sell model, and it's going down, turning this support into resistance, and the process essentially repeats itself over and over again. So that's just one way that you can look at it, and you can use it as your direction or for your bias for the day or for the week, right? Pretty neat, pretty neat. Okay, so the importance of new week opening gap. Reference points. The opening price at the start of the trading week serves as a reference point respected throughout the week and in future weeks. Market behavior indicates whether the market is likely to be range bound or trending based on the price interaction with the gaps. Trading environment. Larger new week gaps typically signal a lower probability trading environment, while smaller gaps suggest higher probability trading conditions. And the same thing applies to NDOGs. So as you can see here, we had that AMD process, so accumulation, manipulation, and then distribution. But you saw how big it was. Notice how price clustered around it, and then notice how small this gap here is, and look how quickly price moved away from it. Now, it won't always look this clean. I cherry picked this example to illustrate what I'm trying to tell you. All right, so keep an eye out for how big these gaps are because it will definitely influence the trading conditions. Okay, so let's talk about EHPDA a little bit more. So definition of event horizon. Event horizon PD array, a concept introduced by ICT as an intermediary level constructed from the average between neighboring new week opening gaps or new day opening gaps. Event horizon is the 50% distance between two NWOGs/NDOGs. Acts as a significant level where price tends to react. Market impact. price reaction. The event horizon can act as a barrier, will not allow price to escape to the new week opening gap, creates a surge towards the NWOG that price got too close to but has not yet reached, right? So sometimes price again will touch up on that EHPDA. It gets close to the new week opening gap that is trying to protect either at the bottom or at the top, but it won't let price escape it unless it's time for price to switch models or it's trying to switch models. And by models, I mean market maker models. Now, premium/discount zones serves as a premium/discount level between two NWOGs/NDOGs, useful for determining optimal entry and exit points based on price's position relative to this midpoint. Now let me zoom in for you to show you what I'm trying to do here. Okay, so as you can see, I set my fib level from the edge of this NWOG to this edge of the new week opening gap. And that is how you get the 50%. Again, you can use an indicator for this, but just for this example, if you want to do it manually, you would do the same thing here. So you would use this edge, drag it up to this edge, and that'll also give you the midpoint or the 50%, right? It's that easy. You don't have to do anything complicated, but again, I would just suggest you stick to indicators because they do a much better job at this. All right, so trading around economic data/events. Market behavior on data days. On days with no major economic data releases in the morning, the market tends to be range bound and lacks clear direction until the afternoon. Afternoon trading, wait for the 1:30 to 2:30 p.m. time window when the market often sees more decisive moves, especially around events like bond auctions scheduled for 1 p.m. So this is where you would use macros, right? Next is identifying key levels, relative equal highs and lows. Look for these formations around the 7 a.m., and 8 a.m., and 9 a.m. trading hours. These can signal potential fakeouts or Judo swing opportunities. Now, this is almost like a different way of trading, right? This section, identifying key levels. If you want to do trading around then, this is like a strategy in a sense, right? You want to look for these relative equal highs/lows around the 7 a.m., 8 a.m., and 9 a.m. trading hours, right? And that's where you could look for like a Judas swing type of trading strategy. Next is strategic timing, entries and exits by anticipating the market's gravitational pull towards NDOGs and NWOGs. Traders can better time entries and exits for higher probability trades. Market dynamics, understanding institutional behaviors around economic events can enhance trading strategies. Now, let's talk about these examples real fast. So here we are using macros, sorry. And let's just say you're trading during that PM session, right? Here we have a break of structure. Price is already reacting through this gap here. And then what does price do? Comes down. We see it reacting off of an area over here. It could be, I don't know, if a value gap, it could be an order block, whatever you want it to react off of. Sweeps this last bit of liquidity here. What does price do? Causes like a change in state of delivery with a fair value gap. We wait for a retracement into that fair value gap and we look for a quick rejection. We got this bullish, very small engulfing candle, but that's good enough. You enter here, stop loss into this low, and then you target this high. It's that easy, that simple. It doesn't need to be more complicated than that. Obviously, this was cherry picked to show you the example, okay? And again, guys, this is one way to trade and this is another way to trade. Now, this example right here. Now, this is one that's very interesting. So here, you can see price reacted from this gap real quick, comes down, sweeps all this liquidity. What does price do? It accumulates, right? It accumulates, but it's reacting positively off of this order block here, okay? And then finally, price inverts this fair value gap. We see nice, strong, pretty strong candle towards the upside. You can enter off of that candle, stop loss under this order block, and what can you target? You can target this new week opening gap. Why? Because it's near external range liquidity. And what did price already do? It came down, took out this internal resting liquidity, and now it wants to go back to ERL, right? And since we have a new week opening gap here, you can target the new week opening gap. Why? Because these types of gaps as ICT says, act as magnets for price. All right, so that is one way that you guys can trade with these types of gaps. Okay, so chapter 3, final notes. So we're gonna do kind of like a quick recap of everything we just went through, just so you guys can ingrain the most important parts, I guess, of this whole presentation. Okay, so conclusion. The new day opening gap, or NDOG for short, and new week opening gap, NWOG for short, are critical concepts in trading, offering deep insights into market sentiment and potential price movements. These gaps highlight areas of liquidity voids that can lead to significant trading opportunities by identifying NDOGs and NWOGs accurately, recording their key levels, highs, lows, midpoints, analyzing price reactions around these gaps, and incorporating the Event Horizon PD Array, or EHPDA for short, as a significant reaction level. Traders can enhance their strategies and make more informed decisions. Understanding these concepts, as emphasized by ICT, can help traders anticipate market behavior based on historical price action and institutional activity. So if you guys didn't understand anything of what I said, just throw it in ChatGPT and I'm pretty sure you'll find the answer. Lastly, additional notes / summary: recording gaps, maintain a minimum of 4 to 5 weeks of NWOG data on your chart for proper perspective of large fund fair valuation. In other words, just record a minimum of 4 to 5 weeks of NWOGs. Okay, that's it. Market structure: a clustering of NDOGs or NWOGs can indicate the market entering a range-bound phase, influencing trading decisions. So just keep an eye out for that. Algorithmic trading: market algorithms often refer back to these gaps, making them essential for understanding price dynamics and potential reversals. Institutional activity: institutions often look to fill these gaps before executing larger moves, driven by the need to establish fair value in the market. NDOG and NWOG as magnets both act as magnets for price to return due to liquidity voids they represent. Event Horizon utility: using the event horizon helps in identifying significant price reaction levels and determining market premium and discount conditions between gaps. EHPDA levels can prevent price from escaping towards a new week opening gap, causing a surge towards the NWOG that it got close to but hasn't yet reached. And again, guys, this does apply to new day opening gaps as well. Okay, thank God we're finally at the end of this video. Oh, good Lord. And now, before I leave you guys, I want to leave you with a little bit of biblical wisdom from Ecclesiastes 7:12. For wisdom is a defense, and money is a defense. But the excellency of knowledge is that wisdom giveth life to them that have it. Sometimes, guys, being the most knowledgeable person and wise person can be the only thing that could save you when money can't, right? So you might have all the money in the world, but if you're not a wise and intelligent person, you're not going to make it very far. And lastly, on this final note, I want to reiterate that you do not need to know new week opening gaps. You don't need to trade with new week opening gaps. You don't need to trade with NDOGs, NWOGs, EHPDAs, whatever, to become a successful trader. All right, these are just tools that you guys can use to make trading strategies around them. But me personally, I don't use them, and I don't really see many traders use them. I only made this video because it seems that a lot of people really wanted to know what this was all about. All right, but if you have any questions, any comments, concerns, let me know down in the description below, not in the description, in the comment section below, and I will do my best to answer. Don't forget to join the Discord. Follow me on social media. The Discord's free, by the way. I don't sell anything, and I try to give out free signals there as often as I can. Sometimes just my bot is down, okay? But for most of the times, I do try to be active as I can there, okay? With that being said, guys, I will talk to you in the next one. Peace.